Hi, I'm Richard Vague with Tychos. On Monday, we woke up to the news that Japan's stock market had dropped by a startling 12%, the most since its calamity of the late 1980s and early 1990s. That came after Japan's central bank had surprised markets by raising rates by 0.25%, or a quarter of a point, after decades with almost no such moves, and its governor hinted at further rate increases. U.S. stocks dropped by a lesser but still ugly 3%. This aligns with our February warning that the U.S. stock market is highly valued and susceptible to these types of corrections. Japan stocks recovered most of that on Tuesday, rebounding by 10%, led, you'll love this, by the Kikkoman soy sauce company, among others, and recovered a bit more Wednesday, a rebound that came after the deputy governor rushed in to reverse that earlier guidance and assure markets that, quote, it is necessary to maintain current levels of monetary easing for the time being, end quote. U.S. markets also continued to recover a bit. A 12% drop might seem like a disproportionate reaction to a mere quarter-point rise in Japan's interest rates, but it was done at a time when markets believed the U.S. central bank was going to lower rates, so reflected fear of the divergence, and Japan's stock market valuation was already very high, and Japan's government debt totals 227% of its GDP, the most by far of any major country. So a quarter point in that huge of a market matters greatly. And its movement was exacerbated by something called the carry trade, a highly leveraged, highly sensitive, and highly speculative activity whereby an investor borrows to invest at Japan's ultra-low interest rates. And the rate increase on those positions caused many to sell stocks to unwind. So, even with the recovery, why the big drop, and what does this mean for the stock market right now? The key context here is that the market value of both the U.S. and Japanese stock markets are up substantially over the last 5 years. Since year-end 2018, it's up 73% in Japan and 111% in the U.S. The overexuberance around artificial intelligence stocks, which is the typical too much too soon behavior of investing in seemingly all new technology breakthroughs, that overexuberance has been a part of this. But make no mistake, stock valuations are high. We see that for both countries in the two most frequently used metrics, the PE ratio itself and the ratio of market cap to GDP. At the beginning of 2024, Japan's stock PE was 15.8, the highest since 2009, pandemic accepted when you had kind of a bizarre denominator for a moment. It was 15.8 and it's now at 15.2, still pretty high. In the U.S., 2024's PE levels have been the highest in over 20 years, again, pandemic accepted. On a market cap to GDP basis, the story is even more telling. Even after the last few days, at an estimated 165% in Japan and 221% in the U.S., 2024's levels have been the highest ever in both countries, with the pandemic caveat again. Simply put, stock markets are at or near all-time highs, and though they can always surprise us, it's more reasonable to expect them to go down than up, but you never know. Beyond this, there are two crucial items I want to point out. First, if we do see a stock market correction, it will not be a stock market correction intertwined with a credit quality crisis. There's a big difference between the two. In 1987 and 2008 in the U.S., Lenders had been profligate in lending to an extreme, and there was a gigantic credit loss reckoning due. The same was true, and even more extreme, in Japan in the late 1980s and 1990s. Those were both combined stock and lending crises, and the stock markets in those situations took years to recover, 5 years for the US, and in Japan's case, an extraordinary 34 years for the Nikkei 225 to reach its previous peak that had been attained in December of 1989. We do not have that egregious combined stock and credit crisis today. When you look at stock market corrections not accompanied by a credit crisis, we have had those with some frequency. Since the global financial crisis of 2008 in the US, we have had 5 corrections of 10% or more, and 2 of those were 20% or more. The average time to recover to that pre-correction level in each of those instances was only 7.5 months. Second, our current market precariousness is exacerbated by the fact that interest rates have been too high. The inflation rate came back down to earth in July of 2022, a full 2 years ago, and at a time when interest rates were only 2%, which makes it obvious that high interest rates were not required to cure that inflation. And while prices are still high, they are no longer increasing rapidly, and ironically, high interest rates are now contributing to keeping prices high. So what happens going forward? First, it's not unreasonable to be prepared for a correction in the U.S. stock market. As mentioned, those happen with some frequency. Second, it's also not unreasonable to think we will have an economic softening. If we do, though, it will be mild. Pandemics aside, major recessions have only come through an egregious overbuilding of real estate, and we don't have that now. The largest sector of the private economy is residential real estate, and we are significantly underbuilt there. Beyond that, the second largest sector of the economy, based on associated debt, is commercial real estate. And the situation is mixed there, with a major challenge in commercial office buildings, obviously. But office buildings are only a small part of the total commercial real estate picture. Given all this, yes, the Fed should lower interest rates and will undoubtedly do that if faced with problematic softening of GDP or stock values. When rate reductions finally come, they'll be welcome. But when that happens, don't expect lending volumes to snap right back up. Lenders look to credit issue more than the impact of interest rates. In today's market turbulence, plus war risk, plus election uncertainty, leaves lenders unsettled. In the final analysis, it's always lender confidence and loan growth that drives economic growth. That's it for this week. Thanks for watching, and as always, keep the conversation going in the comments below.